In this session, we're going to have a look at our final accounting standard for this chapter. We'll be having a look at IAS 18, so International Accounting Standard number 18, all to do with revenue recognition. Now, this particular standard really reinforces the idea of the accruals concept of recognising transactions when they occur, irrespective of when cash is received or paid. Now, when we think about revenue recognition, we are just thinking about income, so sales revenue or other income. So we're going to have a look at two main key points of this standard: when we should recognise income from selling goods and when we should recognise revenue from services. Okay, so it's essentially just remembering some criteria. Okay, so again, this is very much a largely theory-based element to the course. So we're going to have a look at the sale of goods. And if you want to recognise sales or revenue from selling goods, you must meet all 5 criteria. Now, the first criteria, if you're selling goods, is that the risks and rewards of ownership of the goods have passed to the buyer. So let me say, for example, let's say that you buy a book, okay, let's say you buy a book from LSBF, okay, or Interactive. You buy your study text, let's say, and you receive it in hard copy. Now, as soon as you receive that book, all the risks and rewards of ownership have passed to you. We have no more involvement with that book. So if you decide to write in your book, that's what you want to do with it. Okay. If you want to put it in a fire, that's fine. Hopefully you do it at the end of the course, or even keep it. But if you decide to put it in a fire and you want to risk, destroying that book, then that's your responsibility. The risks of ownership have passed to you, but also the rewards of ownership have passed to you. You're going to use that study manual to help you pass your exam. So in terms of goods, the risks and rewards of ownership must have passed to the buyer. The second criteria, I suppose linking in with the first one, the business has no continuing managerial involvement. So once you get your books, that's it, they're your books to keep. Okay, we've got nothing to do with it. Okay, we have no more managerial involvement with those goods. The amount of revenue can be reliably measured. So again, we can reliably measure the value of the book that we're going to sell. Well, that's fine. If you know how much it's going to cost and you know how much profit you want to make, surely you should know how much to sell it for. Okay? So usually that would be the invoice price. Point 4. It is probable that the economic benefits associated with the transaction will flow to the business. So it's more than likely that we're going to receive cash from selling those books, okay? Which again is fine because we would have a reliable expectation, let's say if we sold those books on credit, that our customer would then pay us the money, or else we wouldn't sell the goods on credit. So it's probable, it's more than likely you're going to receive cash from selling those goods. And point 5, the costs incurred can be reliably measured. Well, my argument is if you don't know how much it costs, how on earth do you know how much to sell it for? I mean, that's all about good management accountancy, isn't it? That's what us management accountants do, the costing and then, of course, the markups or margins to establish a selling price. Okay? So if you meet all 5 criteria, then you can recognise the revenue on the sale of goods. I suppose the most important criteria for you to remember really is points 1 and 2. Okay, because they really are to do with goods specifically. The rest are pretty standard in terms of recognising any item in the financial statements. Now, if we compare that to how we recognise revenue on rendering a service, well, we need to have a look at that criteria as well. Rendering of services, in this case, all 4 criteria must be met to recognise the income from a service. Now, I normally teach in class, and I usually teach in class, let's say over 10 days. Now, if I teach in class over 10 days and I do 1 day a week, our year-end cut-off point might fall halfway between those 10 days. So let's say after day 5, that's where our year-end is. Now, if we receive the income in advance from our students from providing this course, and remember, if I'm providing a tuition course, I'm providing a service of me giving you information to help you pass your exam. Well, if I receive that income now, wouldn't you agree that actually part of that would be income that we've received in advance or deferred income? In which case, if I'm receiving, let's say, £100 relating to 10 days worth of course, it's very cheap, I know, but let's just use that as an example. Well then, 5/10 of that, so half of it, would relate to this year end, and then the 5 days that fall after the year end would then be income relating to the next accounting period. So it's very similar to deferred income, I suppose, which you would have seen in the accruals and prepayments chapter. So when we're rendering services, what we must do is measure the stage of completion of the service. And we only recognise the income on a service on a stage of completion basis. So each stage of completion for a course is 1 day. And if I've got a 10-day course and my year end falls halfway through, well, I can only recognise half of the income in this year, and the other half will relate to the next accounting period. So the stage of the completion of the service is very important. You know, with other industries, let's say hairdressers, you know, the completion of the service and the income come at the same time, don't they? Okay, it doesn't take more than a day, usually, to get your hair done. Okay, might be debatable, but for me, it's usually a couple of hours. So a lot of the time, it's not an issue. Usually, it's for services that span a period where the year end falls part-way through. The second criteria then is that you can reliably measure the amount of revenue. Criteria 3, it's probable, more than likely, you're going to receive cash or some other asset in return for that service. And of course, you can reliably measure the cost of that service. Note, that is the same as 3 to 5 for sale of goods. So notice then the most potent criteria, or the most important one, is point 1. Can you reliably measure the stage of completion of the service? Because sometimes the service and the income may not fall on the same day, whereas sale of goods, again, it's pretty easy to establish that the goods have passed to the buyer and therefore we can recognise the revenue. So this is really just an extension of the accruals concept, just saying when we can recognise revenue on goods and services. So if you remember that criteria, it could come up as a numerical question, but also it could come up as a theoretical question as well. Thank you.